Howdy, everybody. Welcome Liberty Call for Thursday, March 27th, 2025. Hope you're having a fantastical day out there in the interwebs. It is a nice day here in Colorado. The sun's not really out, but it's not cold. And I got some ribs on the smoker for tonight. It is going to be a good time. And my MLB app is not working for some reason. I'm trying to get the Astros game to come on because it's going to be first pitch is in like 10 minutes. So we're going to run through this real quick. All right. Well, markets are rattled as President Trump slaps a fresh 25% tariff on imported cars, sparking sell-offs in auto and tech stocks. Hedge funds are piling into short bets. Gold's hitting record highs and GDP growth comes in strong, but investors aren't feeling the love. So before we unpack all the madness, if you could do me a favor, give me some thumbs up, a like, share, subscribe, follow in. Press that notification bell. All righty. Well, let's hop into today's markets. Dow Jones was down 0.37% today. 155 points, closed at 42,299. S&P 500 down 0.38%. 21 points, closed at 5690. NASDAQ down 0.53%. 94 points, closed at 17,804. VIX up 1.91% today. It's at 1866. Canada flat at 0. Brazil up 0.31 and Mexico up 1.15. In Germany, they were down 0.77%. The UK down 0.27%. France down 0.51%. The Netherlands down 0.26%. Spain down 0.07%. Italy up a tenth. And Switzerland down 0.74%. And Portugal up 0.18%. In, Russian exchanges both red today. MOEX down 2.04%. RTSI down 1.61%. And the overnight markets, the Nikkei in Japan was down 0.6%. Australia down 0.38, New Zealand down a tenth. In China, the Shanghai was up 0.15, Shenzhen Component up 0.23, China A50 up 0.58, TJ Shanghai up 0.19, Hang Seng up 0.41, and the Taiwan weighted down 0.06. All right, so those are our markets for today. Why is this giving me problems? Anyways. I just want to see the start of the game while I'm sitting here yapping to you guys. And it's probably everyone and their brother logging in for the first time, and MLB's not ready for it. All righty, well, let's get to the market recap. S&P 500 cut some losses, but remains pressured by Trump auto tariffs. The S&P 500 trimmed some losses Thursday, but remained in negative territory as investors reacted to a new round of tariffs announced by President Trump alongside signs of slowing U.S. economic growth. The big headline: Trump unveiled a 25% tariff on all foreign-made cars and light trucks effective April 2nd, his so-called Liberation Day, and that's in quotes. While aimed at boosting U.S. manufacturing, this move could raise vehicle prices for American consumers and squeeze automakers with complex global supply chains. Car stocks tumbled on the news. General Motors, Ford, Stellantis slid alongside U.S.-listed foreign automakers like Toyota, Honda, and Ferrari. Investors fear higher costs and production disruptions, especially for companies operating in Mexico and Canada. Beyond the auto sector, the tariffs renewed concerns about a broader economic slowdown. Revised Q4 GDP data showed the U.S. grew at an annualized rate of 2.4%, down from 3.1% in Q3. That's slightly above the prior estimate of 2.3%, but still a noticeable deceleration. Economists worry that new tariffs could dampen growth further and reignite inflation pressures. If I could stop here, from the economists and all the smart folks that I pay attention to, they've been saying that GDP will probably be in the red for Q1, and their main reason why is because a lot of imports came in during Q1 to hope, their goal was to get in before the tariffs went into effect, and by doing that, they're kind of front loading a lot of their imports for the year, so that and imports are a negative correlator on or have a negative correlation on GDP. So the expectation is we'll have a negative GDP in Q1 because of all of the excess imports, and then in Q2 imports will probably dry up, significantly because we'll have so much excess inventory, and then it's going to skew the GDP numbers for Q1 and Q2 based on that scenario. Anyways, jumping back in on the corporate front, all eyes are on Lululemon, which reports earnings after the bell. Investors are eager for any insight into consumer spending trends, especially with tariffs threatening to raise prices. Where was I? All right. I read that. Winnebago gained over 5% after a strong earnings report, while Robinhood stayed flat after launching new wealth management and private banking services. AMD, however, dropped more than 3% after Jefferies downgraded the stock, citing rising competition. Bottom line, tariffs are back in the spotlight. Growth is cooling, and investors are nervously watching how it all plays out in quarter two. All right, let's get to some data. Next up is the fourth quarter final GDP report from First Trust. Mr. Strider Elas put this together. Forget GDP for a second. The real headline in today's economic report is corporate profits, which jumped 5.4% in Q4 and are now up 6.9% year over year. The good news, all major sectors contributed. Profits from domestic non-financial firms rose 2%. Financial firms soared 10.7%, and foreign source profits surged 18.8%. But here's the catch. Even with solid profit growth, plunging into the data into capitalized profit models still suggests that the stock market is massively overvalued. Now on to GDP. Q4 growth was revised slightly up to 2.4% annualized, but the mix was less favorable. Weaker consumer spending on services offset gains in net exports, business investment, and housing and government spending. A better barometer of sustainable economic strength, core GDP, which strips out volatile categories like trade and inventories, rose 2.9%, just under the earlier 3% estimate. We also got gross domestic income data, which rose 4.5% in Q4, signaling underlying strength. Inflation came in cooler, with GDP inflation at 2.3%, though still above the Fed's 2% target. On the labor front, jobless claims ticked slightly lower, with initial claims in at 224,000 and continuing claims in at 1.881 million, supporting forecasts for continued job growth through March. Profits are up, growth is steady, but the Fed may hold firm on rates, with nominal GDP running hot at 5%. That's awesome news. All right. Let's get into another article here. Not some good news. U.S. pending home sales limp higher in February off record lows. And this was from Zero Hedge. Pending home sales in the U.S. rose 2% in February, in line with expectations, following 2 months of sharp declines. The modest uptick reflects a rebound from January's weather-driven slowdown, particularly in the South, where contract signings jumped 6.2% after a 9.2% drop. Still, the National Association of Realtors noted that activity remains historically low. Pending home sales are down 7.2% year over year, and the NAR's index remains barely off record lows with a reading of 72. The National Association of Realtors chief economist Lawrence Yoon cautioned that despite February's gain, contract signings are still well below normal historical levels. That's in quotes. Regional breakdowns showed mixed results. The Midwest posted a modest gain, while pending sales fell in the West and Northeast, due in part to continued affordability challenges and elevated mortgage rates. The outlook for improvement remains cloudy, according to J.P. Morgan and the Mortgage Bankers Association. Meaningful growth in home sales likely won't materialize until mortgage rates drop to 5% or lower. Yeah, good luck. As of late March, the 30-year fixed mortgage rate stands at 6.71%. Since pending sales typically lead actual home sales by 1 to 2 months, this data suggests continued sluggishness in the existing home market. Awesome. All right. Well, I got one more article here. This one, the next bailout we, the taxpayer, will be probably responsible for. This article is titled "Fed Urge to Bail Out Hedge Funds During the Next Market Crash. Trillions in basis trades at risk." So goody, we get to bail out the rich people. Remember back in 2019, repocalypse, when overnight repo rates spiked and Wall Street panicked, or March 2020 COVID crash, when the Fed launched a multi-trillion-dollar QE bailout to bail out the financial system. According to a new Brookings Institute paper and recent reports, we may be on the verge of another hedge fund-driven crisis, and the Fed is already prepping for a potential bailout. That's probably why they're reducing how much they're taking off their books, because if they're taking funds off their books, they can't really bring stuff onto their books. I mean, that's my guess. I don't know. At the heart of the issue are basis trades, highly leveraged bets hedge funds make between Treasury securities and futures. These trades rely on cheap funding via repos and are now estimated to exceed $1 trillion. Hedge funds like Citadel, Millennium, and Point72, and others and others have regulatory leverage ratios averaging 7.8x, and some even hitting 56x on certain trades. A slight market shock could force these trades to unwind rapidly, overwhelming the $29 trillion U.S. Treasury market. The Brookings paper proposes a hedge bond purchase facility, a way for the Fed to absorb mass unwinds without launching another round of full-blown quantitative easing. In theory, the Fed would buy treasuries while simultaneously selling offsetting futures, limiting monetary policy side effects. But critics rightly argue that this is just another bailout in disguise. Shocking. While Fed officials acknowledge the moral hazard, the alternative, another systemic meltdown, may force their hand. The 2020 crisis was masked by the pandemic. The next one might expose the full fragility of the system propped up by a handful of hedge funds chasing minuscule profits with extreme leverage. Bottom line, the Fed may soon face another crisis, but on a scale several times larger, whether the elegant hedge facilities or blunt QE, taxpayers may be on the hook again for Wall Street's big bets. All right. Well, that is everything that I was going to cover for today. It is ready to get to baseball season. So hope everyone out there. Oh, hang on. If anyone needs to reach me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a call. I'll be happy to help. Hope everyone out there has a wonderful evening. Be sure to watch some baseball, and I'll talk to everyone next time. Adios.